Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to, the first full week of trading for the month of September. And it was a bit of a tough start to the month of September as last week market volatility kind of showed back up. And of course, that took a lot of people by surprise. But, we've been talking about the market had a big rally in August, that we were overbought, and that we were likely going to have a correction of some sort. And I wrote a couple of articles over the last 2 weeks in particular talking about why a correction before the election. A correction before the election. That should be a coffee mug, right? So it's a correction before the election. Anyway, why that was likely. Again, markets tend to de-risk before that. But it's interesting because whenever there's a bit of a correction, immediately, we have to, and we talked about this before on the show, is that, we have to rationalize it. Why did this occur? What's going on? Is the AI trade now dead? Is it, is it this? Is it that? Is it this thing? A lot of cases, it's really not any of that. It's just the fact that markets had a big rally, and at some point you have, fewer buyers than you have sellers, and stock prices correct. And we always have to step back and remember that, is that, that the market is just a function of buyers and sellers. And as we've talked about before, sellers live higher, buyers live lower. And so as long as, there's a buyer willing or there's a seller willing to sell something, and there's a buyer willing to buy it at a higher price, then prices will move up. But eventually at some point, a buyer is going to go, no, I don't think I want that here. Think about you and yourself, just as you do in kind of your normal everyday life. And you go, man, I need to go buy something, right? And so you go online to Amazon, just as an example, and you look up whatever item it is that you're looking for. It's like, man, that's like $150. I don't really need that right now, right? That's because the price is too high for you. And so now if you would find that price cheaper somewhere, right, you might buy it. If you could find that same item for a little bit less money, maybe you would buy it. But that's how we work in life, right? Well, the same thing applies to the stock market. Remember, the stock market is just a whole bunch of people in there willing to buy and sell, and it's all based on price. And at some point, investors go, I'm just not willing to pay that price. And so when buyers when buyers are out there going, I'm not willing to pay that price, sellers go, okay, well, if you won't pay that, how about this? Because they want to sell, right? They're wanting to liquidate a position. And so when somebody actually sells for a little bit less price, then the next seller that was in line hoping for that higher price goes, man, I better sell now because that price is coming down. And so you kind of get this rush of selling, and that causes these corrections. But again, always remember that as humans, we have to have some rationalization for the chaos. Why is this happening? Well, it's because of this. Most often it's not. Right? It's just a function of buyers and sellers in the markets, and we reached a price where buyers were willing to say, I'm not going to pay for that. It's too much money. I'm just not going to do it, right? And so that's what happens here. And again, and this is why technical analysis kind of help you navigate markets a little bit more, because it kind of, what all technical analysis is a picture of market psychology. That's all it is. It's not voodoo, it's not witchcraft, it's not magic. It's just a picture of what is happening in the markets on a real-time basis. What is the psychology and the temperament of the markets on a real-time basis? So again, just, and we've been talking about this, is that markets were overbought. We needed to have a correction, and so we got that correction, right? So here's what you need to know before the bell this morning. Markets are probably going to bounce this week. And as we pointed out in the newsletter this last weekend, on a couple of different bases, the markets are now very oversold. Again, and we'd spoken about the fact that we had declining momentum previously. That had triggered a sell signal in the markets. We still have that sell signal in place, so upside of any rally near term is going to be limited. And so we're potentially going to see a bit of a rally here, probably in the next day or two or three. Markets are set to open up this morning. We'll see how they hold through the day. But again, we should have a bit of a rally here. And that will allow you, if you kind of got caught into this downtrend and you haven't taken any action in your portfolio yet. We were talking over the last 2-3 weeks about use the rally, raise cash, rebalance risk, and those type of things, and that kind of helped prepare for this correction a bit. But if you didn't do anything, hey, it's not too late. Get a bit of a rally here back towards the 50-day moving average, and that's probably going to be a decent exit point if you need to reduce some risk a bit. Now, that doesn't mean sell everything, right? It means just rebalance overweight positions. Check, see stocks in your portfolio that aren't performing well. Maybe it's time to let those go. Those type of things. Just do some basic kind of gardening, pruning and weeding in your portfolio, and you'll be fine here. But again, we broke through on Thursday, we kind of broke through the 50-day moving average. Now, as we've talked about before, one of the things about breaks of moving averages is that a lot of times you'll get a break and then a retest and a failure the next day, and then that kind of confirms that the break was valid. Well, that happened on Friday. On Friday morning, we actually tried to break back above the 50-day at the open and immediately gave that up and sold off for the rest of the day. Pretty decent sell-off into the end of the day on Friday, challenging the 100-day moving average. So there's decent support right here at the 100-day moving average that kind of goes back to this bottom that we had set in the initial sell-off back in really kind of late July, early August. So there's a bit of support here right above the 100-day moving average. Below that, it gets pretty tenuous. If we break through that 100-day moving average, we're going to retest these lows of August, which is also where the 200-day moving average is now. So there is some more downside to the markets, and that is certainly a risk worth paying attention to, because we are in a corrective cycle. But on a very short-term basis, markets are very oversold here on multiple levels. So again, a bit of a reflexive rally takes you back to the 50-day. Good place to try to reduce some risk, rebalance portfolios a bit, just to hedge in case that this correction continues going into kind of the election. Now, a couple of things about seasonality. September tends to be a weak month. Well, we've already started off on the weak side for September, so it's living up true to name. October tends to be where markets bottom historically. So if you think about the crash of 87, a lot of these bigger downturns in markets, they bottomed in October. And there's a few reasons for why markets tend to bottom in October. So if you have this correction that begins in September and carries into October heading into the election, which that would seasonally kind of be normal for a presidential election, as we've talked about before, markets tend to de-risk going into the election. Well, we've certainly started that process here, as we've talked about. Now, the issue is that once there's a firming in the polls and it looks like Wall Street can kind of get a handle on who's probably going to win the election, we'll probably start to see the markets firm up a bit post the election. Then that's going to get a lot better. A couple of other factors kind of weighing on markets right now. As of Thursday, the share buybacks, corporate share buybacks, are going back into blackout now. So every day as we get closer to earnings, more and more companies are being blackout from buybacks. That's going to remove one of the buyers from the markets. So that's going to put some more pressure on stocks going into earnings. Now, once we get through earnings, about the third week of October, that window is going to open back up again. So again, heading into November, that's going to be a better opportunity potentially for for a rally to kind of reform itself going into the end of the year, because you'll have behind us, you'll have the election, we'll have a decent look at earnings for the third quarter, and you'll have buybacks enter back in the window. So just kind of be prepared. This could be a sloppy couple of months, a lot like we saw last summer. 2024 is acting a lot like 2023. A sloppy couple of months, September, October, and then you get that year-end rally once you kind of get a firming of information and context after the election about what policies are going to be, who's won, who controls House, Senate, etc. So just be, that's what I'm saying, use a rally here to kind of prepare yourself for some volatility pickup over the next month or so. All right, take a quick break. We'll come back. Got a lot of stuff to get into this morning. Don't go away. You're listening to The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Really great question in the chat just a few seconds ago asking this. It says the question is this. This may seem like a stupid question, but who gets the difference between profits or losses in a transaction? In other words, the buy and sell of a stock, the company who issued the stock or the market who listed it? Great question. And here's why it's a great question, because this goes directly to a lot of the fallacies that run around in the stock market. Particularly around share buybacks. So when a company takes a stock public, and this is why you never buy IPOs, or should never buy an IPO, because when a company lists a stock publicly, that is the price that they're getting for the company. So let's make this really basic. I have a company. Private. I just have a private company. I own the local dry cleaner right on your corner. And you come to me one day and you say, Lance, I want to buy your dry cleaners. And I go, okay, great. I'll sell it to you. Well, so we negotiate a price and I sell you my dry cleaning company. I now have your cash. You now have the company. Okay. Same thing in an IPO. A company that was private has decided to go public and they sell a portion of the company to public shareholders. Same as a private transaction. So the only thing that the company gets at the IPO. So this is why they talk about, the IPO price, and they'll have it kind of marked at some level, say, we're going to take this company public at 25, but there's a lot of demand for the stock. And so you'll see the IPO offering move up. So they're going to say, well, it's now 28. The initial price is going to be 32, whatever it is. Or if there's not a lot of demand, that price will decline. And that's where they're setting up. But this is where the company has agreed. They agree to sell the company at X price, $32 a share. They're going to offer out 1 million shares of their company for public listing. That might be a total of 10% of the company that they sell out publicly, whatever it is. But that's all they get. At the day of the IPO, the only thing the company gets is $25 a share or whatever the number is. So they get that money. They put that in their bank account. Now they are public and they can go do whatever they want to do with their company. From that day forward, all that's happening is a bunch of people like you and me buying and selling that stock. So in, kind of just a base example, I decide to sell 10% of my company to 10 other people, right? So now 10 people own 1% each of my dry cleaner. Brent owns 1% of the company. He goes to Mike Leibowitz, who owns the other 1% of it, and says, Mike, I'll buy your 1% of the company if you want to sell it. And so Mike says, yeah, bought it for $25. I'll sell it to you for $27, right? So Brent buys the share for $27. So now Brent owns 2 shares of the company and Mike doesn't own any. Now, Mike made $2 on his transaction because he bought it for $25 and he sold it for $27. Brent now owns 2 shares of the company, but Mike doesn't own any, but Mike has Brent's $27. Now, that did nothing to my company. All I know is that now Brent owns 2% of the company versus 1% previously. That's all I know. Don't know what the transaction did, have no idea what the terms were. I just know that Brent now owns 2 shares of my company. Well, Brent goes to another shareholder. He goes over to John Penn and says, John, I'll buy your 1% of the company as well. John says, well, I know you just paid Mike, that dummy, $27. So I want $28. And so Brent goes, okay, fine, I'll give you $28. So Brent gives him $28. Brent now owns 3 shares. None of this affects the company. It's just you and somebody else trading shares amongst each other. And this is why share buybacks as a return of capital to shareholders is the biggest scam on the planet. Because it doesn't return a dime to shareholders. All that's happening with a share buyback is that the company says, we're going to buy back our shares, but they can buy the shares back any day they want on the open exchange. They could just go into the market, open up an account and for Apple computers and buy all the shares they want on the open exchange. They could do that, but that's not really a share buyback. That's just them buying their own shares. What they're doing internally is redeeming the shares that they gave to their insiders. That's the share buyback. Because again, as we talked about before on the show, Apple doesn't send you a computer when Apple decides to send you a computer. Sorry, send you a letter. When Apple decides to do a share buyback, they don't send you a letter and say, "Hey, we're buying back our company shares. Would you like to sell them to us?" You could do that any day on the market, right? What they're doing is they're redeeming those shares that they've issued internally, restricted shares, etc. But it doesn't return. Even when they do that, you don't get a check in the mail for them buying back shares. So there's no return of capital to you. Now, a dividend is a return of capital, right? The company is actually taking money they earned and sending to you as a dividend. Now, that's a return of capital because you actually get that. But in a buyback, there's no such transaction. But yeah, it's a great question because a lot of people don't understand how the market actually works. The market has nothing really to do with the underlying company other than the fact that it's a source of capital for the underlying companies. If Apple needs to raise some more capital for some reason, they can go out and sell more shares to the markets. They can go to the public debt market and they can offer debt to be sold publicly. They have access to capital markets to raise capital. But from the company perspective, the only thing the market is good for is raising capital when I need it. I need some more capital, I issue some secondary shares. I need some more capital, I issue some debt. That's not an advantage that the vast majority of private companies have access to. You know, going back to our dry cleaner on the corner example, if the dry cleaner on the corner needs to raise capital, he's got very limited options. He can go to the bank and maybe if the bank's in a good mood, we'll loan him some money. Or he's got to go find a private investor, like I've got to go find Brent, to buy some shares of my company, right? Buy some ownership stake in my company so I can raise capital, or maybe make me a private loan. But access to capital is very difficult as a small business. This is why this is why 80% of small businesses fail is two reasons. One, lack of financial management. Two, lack of access to capital. Those two number one reasons. But once you're public, access to capital becomes very easy because I can just sell more shares. We've seen lots of companies do this. Ryan Cohen over at GameStop, every time these meme stock traders run GameStop up, he issues out another $500 million in shares, raise capital for the company. Genius move. Take advantage of stupidity. But it's a great question, because if every company stopped issuing shares, as an example, and just said, okay, nobody's going to issue any more shares, nobody's going to raise capital in open markets, then the S&P would simply be a function of individuals buying and selling the same shares between each other, because there's no more supply. So if there's no more buybacks reducing supply, and there's no more issuance increasing supply, then all that's left is just you and me and Brent and everybody else in the markets just buying and selling the same shares between each other. And this is why technical analysis is such an important facet. Just understanding basic analysis. You don't have to be all fancy, right? Understand a couple of moving averages, a relative strength index, a MACD. That's all you really need. But just understand the basics of technicals, because that is a picture, that is a window into that pool of buyers and who's buying and who's selling and at what price are they selling. It applies to the overall market. It applies to individual securities. But you can see in real time what is happening in that massive pool of investors and what they're doing. Are there more buyers than there are sellers? Are there more sellers than there are buyers? And you can take all this other narrative stuff and just stick it away over here, because the market will tell you that. As we've talked about before, there is nothing that you can think of right now, today, this moment. There is nothing that you're thinking of at the moment that is going to be the next great undoing of the market, because the market's already thought. If you've thought of it, so have a million other people that are trading this market. And you got to remember, there's hundreds of millions of people out around the world trading stocks, right? All over the world, right? International stocks, domestic stocks, emerging market stocks, etc. Tons of money. So if you're thinking it, probably at least one other person is thinking it. And this is why when every transaction occurs, all you need to do is measure how difficult was it to get that transaction done. Are buyers becoming more scarce, or are sellers becoming more abundant, or vice versa? And if you've got a lot more sellers than you've got buyers, prices are going to go down. If you've got a lot more buyers than you've got sellers, prices are going to go up. It's just a function of how that market, right, is going to work, because it's all based ultimately on supply and demand. Great question. Appreciate that. Got me a little off topic this morning, but we'll come back and get back on topic. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I remember in school those history stories about the late 1800s, and now Gen Z kids are now calling the 90s the late 1900s.
The Real Investment Show podcast.
And I feel like I just drank from the wrong grail in Indiana Jones.
Same show, your schedule.
I was talking to my daughter a few weeks ago, and I said something that she didn't agree with, and she goes, "Dad, you're just getting old and not relevant anymore."
At realinvestmentadvice.com.
Not relevant.
You're not relevant.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So let's talk a little bit about Friday's job report, since I wasn't here on Friday. Another interesting one, to say the least. It was kind of like Goldilocks and the Three Bears, right? Not too hot, not too cold. And it really wasn't just right either. But it wasn't too hot and it wasn't too cold, right? But, you know, we did create some jobs, but not as many as expected. The internals continue to be a disaster. And, of course, we revised down previous reports once again. So the jobs outlook is really much weaker than headlines suggest. And this isn't, you know, kind of anything new. And we've talked about this before. I've written some articles on it as well on the website. So if you go to realinvestmentadvice.com and just, you know, Google jobs, or just put in the search bar at the top, you know, employment, jobs, etc., BLS, you'll get some of our recent writings on, you know, kind of the different jobs reports that have come out when they've mattered. But again, the one thing we keep talking about, and the one thing, and this, look, it didn't clarify, the jobs report didn't really clarify the 50 basis point cut in September or this month by the Fed. I'm still pretty much in the camp that the Fed will cut 25 basis points, not 50, and the jobs report wasn't nearly weak enough to justify a 50 basis point cut. So I still think they're going to cut 25. But clearly the jobs outlook is slowing down. And again, the things that matter economically are full-time jobs. And the full-time employment to population or labor force ratio has now dropped to about 49.3. Now, you have to understand this, is that going back in time, we used to have full-time employment to the labor force that was running close to 70%. We're now down to 49. We haven't seen a real increase in the labor force participation rate since the peak of the market in 2000, when we shifted the economy and moved more towards global outsourcing of jobs, all kinds of other, interventions and supports, the invention of the internet, et cetera, which have made, productivity much higher. And that's led to weaker job growth. Now, the question becomes where are all these other people, right? If we look at the labor force participation rate, and you look at how many people we have in the economy, you got 330 million people in America. Now, some of those are students, right? Some are babies. We can't work them just yet, right? Can't do the $2 a day for 4-year-old child labor. That's still against the law right now. Not in other countries, but here. So there are a group of people out of 330 million people. There is a big chunk of those people that are in school or too old or too young to work. So if you just look at 16 to say 54 years of age, right? Those people should be working, right? 16, somewhere between 16 and 18 if you don't go to college, and then 54, that's not even retirement age yet, you should be working. So we just look at that group of people, we see a declining number of people that are working. There's actually about 10 million people that are just missing. Don't know where they've gone to, but they're just gone, right? We just don't count them anymore. They're somewhere, right? But there's like 10 million people we just simply don't count. They're just not on the rolls anymore. And then there's the function of the people that are participating in the labor force that we've had a significant increase in the population, but we haven't had a significant increase in labor force participation rate. So where are those people? Of course, some of those are on welfare, of course, and some of them, they're working multiple part-time jobs, so we just don't count them. Even though they're out there working, we just don't count them anymore. And this has a lot to do with the problems with government statistics and how we count things, right? And back in the day, back in the 60s, as the Spot was talking about a second ago, in that last century when people were actually having to do math with like a slide rule, back in the mid-1900s, people used to have to, economists had to actually do math with a slide rule. And you have to have, if you're going to use a slide rule, and which is amazing, if you think about the fact that we put men on the moon with a slide rule and a TI calculator that had the memory of a pen. It's pretty amazing what these guys did with math, right? And then, but as we've advanced technology and, calculators and computers, et cetera, we've gotten lazy. And we don't do the math the way we used to do math. And again, when you're using a slide rule, this is how old I am. I remember using a slide rule growing up. So just that's how old I am. But, when you do math with a slide rule, as an example, you have to not just do the math. You have to think about where the math is going. Right? You have to project out, okay, here's what the math is saying right now, but where is this taking me to? What's the next logical step or progression, et cetera? And as we got calculators and computers, everybody just kind of got lazy. And this is the problem with a lot of government economic and really in general economic analysis today, is that people are just lazy. They look at the number today and they say, oh, well, that's a positive number. Okay, yeah, that's true. It's a positive number. But what's it telling you? It tells you nothing. Let me give you an example. If I told you that the jobs report next month was negative 100,000 people, you'd say, oh, that's terrible. We lost 100,000 people. But see, a number in isolation doesn't mean anything. And this is the problem with the analysis, is that we just take this data on a 1 month basis and we look at it in isolation and say, oh, that number is good or bad. But it doesn't tell you anything. See, we printed 145,000 jobs on Friday. Yes, true. It was weaker than expected. Expectations were higher, so it was weaker than expected. So it's a bad number, right? No, not really. It's still positive. If I told you that the number last month was negative 100,000 and this was a positive 145,000, now see, it's a good number because the number is higher than last month. See, where the data becomes important is the trend of the data. What is the data telling us in terms of a trend? Is it a strengthening trend of employment or is it weakening? Now, obviously, we've been in a weakening trend of employment for months now. Actually, ever since last year. The trend of employment is getting weaker. The number doesn't mean anything. And this is the problem with lazy analysis these days, is that we don't look at the data and say, okay, where is this taking me to? What path am I on with this data? And the data is clearly weakening. And this is why we want to look at things relative to the overall economy. Labor force, how many people are employed full-time relative to the labor force? Why is full-time employment important? Full-time employment is important because that's where your benefits come from for healthcare. That's where your higher salaries are. Who makes more money? A full-time worker or a part-time worker? I'm not even saying the same job. They both work in a restaurant. Who makes more money? The full-time employee or the part-time employee? Who makes more money? Full-time employment pays higher wages, which allows individuals to support their family, right? And what makes an economy work? What makes an economy work is demographics. I need more people in the economy producing something so they consume, right? They go buy a house, they buy a car, they buy a TV, whatever it is. But they've got to work first in order to consume second. So we clearly have a weakening trend of full-time employment, which suggests, the trend tells us, and the history of the data tells us, that when you have a weakening trend of full-time employment, you have what? Weaker economic growth. And this is why back in the late 1900s, that trend of full-time employment was rising steadily. And as a function, we were running stronger rates of economic growth. Since 2000, we've had a declining trend of full-time employment, and now we're just hoping to get to 2% growth rate. If we can just maintain 2% economic growth, we're great. But see, in the late 1900s, if you were running at 2% economic growth, that was considered pre-recessionary. Today, it's just a target we hope we can get to and hold on to for dear life, right? So we have to start looking at the data for what not only what it's telling us today, but where it's telling us we're going to be tomorrow, the month after, next year. Because employment, economic data, inflation data, et cetera, all tells us stories about the economy, but it doesn't tell you anything significant about today. 1 month of data tells you nothing. But the problem is that computers have made us terribly lazy. As they always say, garbage in, garbage out. That's what's happening with a lot of our economic data. And that's why you don't agree with a lot of the economic data that is produced by the government, because it's garbage data in. There's no real analysis behind it. And so you get garbage out. All right, quick break. Come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And good morning. Welcome back to the show. Get ready to wrap things up. I want to spin off that last conversation we had because the technology discussion with employment is important. And I wrote an article about this on Friday. Excuse me. So I wrote an article on Friday talking about technological advances. Do they really make things better? Right? The argument is that technology is awesome because it makes us more productive. And as we increase technology, it replaces jobs, menial jobs that people don't want to do. And that allows those people to go get a better education to do a higher paying job. That's the thesis anyway, right? That's been the thesis for the last really 25 years. And Ray Kurzwell wrote a book. It's a fascinating book, if you ever get a chance to read it. And he laid out, he discussed the pace of change with technology over time. And again, the important thing here, I can bring, thanks. I was going to get Brent to bring this chart up, but he beat me to it. So in this book, and the book was called The Age of Spiritual Machines. And this was in 1999. He wrote this book, and he lays out this projection of technology. And it's a remarkable book if you've never read it. It's quite phenomenal. But he predicted mobile phones and a lot of other things that came along, mobile computing, etc. Out of the 147 predictions that he made in the 1990s, 78% of them were correct. That's a hell of a hit rate for anybody, right? So pretty amazing. And he made a lot of predictions. So, but the question is, we talk about this technology, right? And this is great. And it's going to make things better. And it makes us more functional in economies and all this type of stuff. The problem is that if we look at some of the data, it doesn't seem to have really worked out that way. The idea is that if you lose your job to technology, let's say that you work in a manufacturing plant, now they use a robot to do your job. Well, supposedly you're supposed to go out now and get re-educated and do something better. But what they don't talk about, and again, this is where we go back to lazy economists, right? But what they don't think about is that, well, wait a second, I just displaced a job that required a human. So if I can displace that job, then what other jobs can I displace? And as we talked about before, when you do things like the Affordable Care Act that makes health care much more expensive on employers and employees, or if you do changes to policy that put more onus or more burden on employers, higher taxes, etc., their first response is going to be reduce employment. And we've seen this ever since 1947. And it becomes extremely clear. Going back to 1947, there's a very clear trend of employment over time. And this is what I call the real situation report. Beginning in the late 90s and accelerating in 1999, employment fell well below the long-term trend of employment, and employment tracks economic growth, by the way, going back to 1947. So what happened? I thought that what technology was supposed to do is all these employed people that lost their job to outsourcing and technology, et cetera, they were going to go get reemployed. The theory is, of course, if I was on the line of an automobile plant building cars, and we now have displaced me with a robot that can do spot welding, et cetera, then I'm going to go out and I'm going to learn to program robots, right? That doesn't happen in real life. It's a nice theory, right? And this is the problem with economists. They have nice theories, but it doesn't really work out that way in real life. This is the problem with all economic theories. All the economic theories are, for instance, if meat's too expensive, if a steak's too expensive, you'll go buy chicken. That's not the way people really react to things. It's theory. In theory, it sounds great, but in reality, that's not how people respond. And this is why most economic theory winds up wrong over time, because how people respond in real life is very different than what economists think people are going to do. But this idea of technology kind of improving things isn't really a function of improving things for the average worker. This is a chart. So I was talking about employment to population earlier, and you can see that beginning in the dot-com, before the dot-com revolution, right? So now technology is supposed to make everything better, right? So we're going to make us more efficient, more productive, et cetera, so forth and so on. It's awesome. Everybody's going to benefit from this. But before we had the internet, where you had to look things up in an encyclopedia, it required a lot of people to work. So the employment to population ratio was rising from 1947 to 1998. We peaked in 1998. Now, as you would expect, with more people working in the economy, more people are making money, more people are and doing things, are spending money. So, the market's doing well. And there's a very interesting correlation between employment to population versus the market going through the 1990s. But then we do the internet, and we start losing employment relative to the population, right? Because we're displacing workers. I don't need 5 people to do things that I can get one person to do things with because of the internet. And then in 2007, so we go through the dot-com crisis, and then the economy starts to recover going into 2007, And of course, that's when social media launches and Facebook becomes public and all this. But then we have the financial crisis on top of that. So we have another big drop in employment. And then from 2009 through 2020, we get the economy back on track again. And artificial intelligence actually started about a decade ago, which has really kind of gone mainstream lately. But, artificial intelligence is the next thing, right? It's going to make everything better. But you'll notice that at every point we have these technological innovations, we never get employment to population back to previous levels. We always wind up at a lower level than the peak. But yet the stock market's continuing to go up because efficiency is helping profitability for these companies. And I've got a chart for you for this. Drum roll, please. This chart that Brent's going to show you just any moment now. It's coming. It's anticipation. So the blue shaded area is corporate profits after tax. And this includes valuation adjustments. And you can see that as we go through innovations in technology, that corporate profitability continues to rise. But the red line is the amount of corporate profits relative to wages. And you see the problem here. So wait a second. I thought technology was supposed to make everything better because it allowed people to go get higher paying jobs, which means wages would be increasing for every American. But that didn't really happen. Now, the good news is wages versus profits have stabilized since about 2015. So we'll see if that trend continues or not. But again, we're just kind of getting to the point now that the profit to wages ratio really can't go down much more without getting rid of a lot more workers. But maybe that's where artificial intelligence, kind of really starts to come in. So, but this is the issue. And of course, the big impact of this has been this massive increase in the wealth gap. And as we continue to use technology as corporate owners use technology to increase profitability and offset the cost of rising wages, rising healthcare costs, you want more benefits, you want more time off, you want paid leave, you want this, you want that. All that's a cost that has to be offset by the company. And companies are willing to pay it because they need the labor, but they've got to do that efficiently, which means that more and more of that shift becomes to automation, which reduces employment in the population. Now, remember, most of your big corporations, big businesses, et cetera, that employ most of the people in the country, even medium-sized and large-sized small businesses, those individuals tend to be more wealthy than the laborers, right? The producers or the providers of labor tend to be the beneficiaries of the labor, wealth-wise. And this is why we have this huge wealth gap, right? So the top 10% of income earners own a vast majority of the wealth. The next 50, the next 40% below that make up a much smaller portion. They've seen some increase over the recent decades, but the bottom 50%, they barely show up in the index. So the bottom 50% are the providers of labor, right? They're the ones that are providing the labor. They haven't really benefited from technology. So all this idea that technology makes everything better really hasn't. And if you take a look at the article, which is on the website from Friday, there's a couple of other graphs in here talking about social loneliness, teenage suicide. Ever since the advent of social media, things have gotten markedly worse for the average American. So does technology make everything better? You can read the article and decide for yourself. All right, wraps up the show for the day. Have a great day. Be back tomorrow with John Penn. Markets should be up today. We'll see if we can hold on to the gains this morning, but we'll talk about it in the morning. Have a great day. We'll see you tomorrow.